a often used refrain. We're going to have to sit here for a while. We need a little bit more confidence. Bilal Hafeez is the CEO of Macro Hive, joins me now. So, Bilal, I looked through the body context of what he said. He's talking about the biggest uncertainty is the pressure on the economy. We can debate about the wealth gap and where that pressure comes to bear in a moment. But for a while longer, what does that mean? The market is saying September. Does that rhyme and chime for you? September live and a 25 basis point cut then?
I mean, my bias overall is actually not for a September cut. Instead, I think the risk is that we don't see any cuts this year. So I think yesterday's data, while it has pulled forward rate cuts, I think the market is overestimating the possibility of cuts. I do think that the US economy remains strong overall. I do think there also is persistent inflation, especially in the services sector. So I think the market's getting a bit ahead of itself. And my bias at this stage, at least, is not to expect a cut in September.
And it's interesting. I started the show by saying, you know, bang for your better than expected buck in the bond market. In other words, we came down by 10 basis points. And yet when we got the hotter print, it ratcheted by 16, 17 basis points at one juncture. So there is this reaction function to incrementally better news relative to bearish news. Is the CPI as credible? UBS were with me yesterday saying owner's equivalent rent is nothing more than a fantasy. So really, how much credibility does CPI have in terms of the bleed through to PCE?
Well, there is a widening gap between CPI and then also PCE. But in general, I think what you have to do is you have to look at across a number of different inflation metrics to get a true sense. It is true that the OER measure is in the end some kind of weird moving average over 12 months. And in reality, if you look at other measures or surveys of, say, consumer confidence and such, most people on the street are still feeling inflationary pressures are very, very strong. So overall, that tells us that there are still inflation problems across the economy at the moment.
So here's the debate, and Andrew Bailey encapsulated it beautifully for me, so much so that I'll use it 3 times. If it's good, overuse it, I say. It is not 1998. It is not 2001. It's not even 2019. So what is the cadence that we can expect here in terms of we are going into somewhat of an unknown, a fairly strong US economy without an exogenous shock at the moment? And I emphasize the word at the moment because typically macro policy is only provoked or irritated into real movement by a dramatic exogenous shock. So what kind of cadence can you really look at if we're underestimating the solidity of the US economy?
Yes, absolutely. I mean, I think it's hard to draw parallels to the recent past, so recent being the last 20 or 30 years, because we've been in this environment, at least since the mid-1980s, of declining inflation driven by globalization and all those sorts of factors. And since COVID, we've had a fundamental regime change, and everyone's trying to grapple around, is this a genuine regime change, or are we going to revert back to what we had before COVID? My sense is this is a regime change, so the cadence has changed, and there are important structural forces. One example is deglobalization, which is popularized by the clash between US and China, which is going to lead to higher inflation. And the other is, if you listen to central banks, frankly, they don't know what is causing inflation. They don't know how their monetary policy is affecting inflation as well. And that high level of uncertainty tells us that nobody really knows, what's going to happen in the future, nor do they know how to calibrate policy in the right way. So all of that tells me that we're going to end up with an outcome that nobody likes.
Well, we have a bifurcation in where policy is restrictive, don't we? This plays to what Paul Donovan said yesterday, which is, lower class, blue-collar workers are having a tougher time in a 5% high inflation, grocery store, gasoline, living costs. They are materially biting. We're spending less at Walmart, at Starbucks, and those kind of companies were becoming more judicious. But the middle class, those people with savings and house and home equity, is indeed weathering this very well. And this is where the transmission mechanism of monetary policy is ultimately bifurcated.
That's correct, and that's been one of the key features of what we've seen over the last few years, because people have locked in low mortgage rates, out to 30 years. So homeowners have not been affected by the increase in interest rates that the Fed has engaged in, whereas people at the lower income bracket, where they don't own their houses, instead they have to pay higher rents, they've been affected by high interest rates, which feed through to higher rents. Indeed, there is this bifurcation, and on top of that, in the US in particular, there's been a surge in immigration as well. So there's been this influx of additional workers into the US economy, which has pushed up rents and other such parts of the market. So there's all these new dynamics that we've seen over the past few years. And in the end, this does put more pressure on the income inequality dynamic that you're seeing in the US, but equally across the developed world.
It's interesting, but just looking at what Torsten Slok sent through from Apollo, of course, he's saying no rate cuts this year, but he talks about the very essence of wealth, which is about how US homeowners, in terms of their expectations, their wealth, as it were. This is household expectations to house price appreciation. It's the highest since 2007. And this is the very essence of strength in the consumer in the United States, isn't it?
Yeah, and I would say there's two things related to that. One is that people's implied wealth has gone up a huge amount because house prices have gone up. And then the other side is, on the liability side, the value of their debt has gone down in some ways because they've borrowed at low interest rates, and interest rates have gone up elsewhere. And so in some ways, their borrowing has, from a wealth perspective, gone down. So from a net asset perspective, they've benefited both from the asset side and the liability side, which gives them a big benefit.
Bilal, great to have you with us on the reaction function. The bond market seems to have voted with its feet for the moment, but let's see whether that carries through. Bilal Hafeez of Macro Hive. Other stories,